Welcome to another unit in this course on economics. This time I'm going to talk about business cycles, the basic design of a classical business cycle, and how key economic variables develop in the different phases of the ideal business cycle. So we can start with the design of a classical business cycle, whereas we can see here that it consists of three main phases: the growth, boom, recession, and depression phase. Those phases, it fluctuates or following a guiding here called growth path. So that's more or less like the long-term general trend which the economic development follows, whereas the fluctuations are short to medium term fluctuations. So we actually have two questions we can talk about here. We can talk about the long-term growth path. This is, usually considered in the context of economic growth theories like the neoclassical growth model, which is the topic of a later session. And we can talk about the medium-term fluctuations, which here is the archetypical business cycle, where we assume that the length of such a business cycle lies somewhere between 4 to 7 years. And that's also what I'm going to talk about in this session, and in particular, how different variables develop in the different phases of this business cycle. So let's start with the first phase, the growth phase. And here we assume we have an increase in production. Increasing orders, companies produce more. Well, if they produce more, they also need more workers. More workers means unemployment rate will decrease. Well, if unemployment decreases, workers become scarcer. If workers become scarcer, their price will increase, so we will have increasing wages. Okay, so the people work more, unemployment goes back, they have higher wages, so they have more money available. If they spend more money, goods will become scarcer. So in other words, the prices will increase. Higher wages usually lead to, generally speaking, higher prices. So we will have an increase in inflation. But the arguments that hold for more workers hold similarly for more investments, because to produce more, I also need more capital. If I invest more, I need more money to pay for the investment. So the price for capital will also increase. And the price for capital, that's our interest rate. So we will also have increasing interest rates. This continues until we reach the boom phase, where we actually achieve the maximum in all of this. We have full employment. Everyone who wants to work will have a job. Therefore, not only with employment, we have a full utilization, but for other production factors like capital as well. And in consequence, we will have very high wage levels and very high interest rates, because the price for labor and capital will be at its maximum. The same also goes for wages, for prices, because here we argued increasing prices lead to increasing wages lead to increasing prices, to increasing inflation. And if here the wages are at their maximum, prices will also be at their maximum. So that's what we get in the boom phase. So summarized, we have an overheating of the market. However, our growth rates, because there is no longer any potential for growth, they will start to stagnate. They will slowly going down. And if you're having a company and you see that growth potential is going down, But on the other hand, prices for factors like labor and capital increase, you might wait with your investments. You might decide to not invest because the potential for the future is relatively bleak. So in total, this falling growth rates, which still are positive, they will only just decline, might turn into the negative, but they will lead to postponements from the part of the companies. And also, well, even the households will see that prices will increase significantly. So they also might postpone long-term investments. So in total, demand will slightly decrease, leading from the boom phase to the beginning of a recession phase, of an economic downturn. Demand will slowly go down. This means we will also get losses in the stock market, as I said, due to decrease of demand. Decrease in demand means we cannot sell, if we have a push production, everything we yet produced. So even if we have a decently sized workforce, we start introducing overtime reductions or reduced work hours, and in the severe situations we might start firing people. So we have an increase in the unemployment rate. Okay, we have an increase in unemployment. This also means that labor becomes cheaper, so wages might stagnate or even decrease. Same thing holds for investment. Well, I'm not investing if the economy is going down. So we have less investments, meaning even more of the decrease in demand I mentioned here. And due to the fact that we invest less, the companies need less credit, the price for credits falls, so the interest rates also decrease. That's basically the parts mentioned here. If the people have less money available, they buy less. That's also the consequence of the full inventories. The prices for the goods will drop. So the situation becomes worse and worse, and the recession turns into a depression phase. A phase which in the stock market means we have a bear market, we have very high unemployment rates, we have a deflation, a significant price decrease, and we have very low wages and interest rates. Okay, now we have this situation, very low wages, very low interest rates, stagnation in the market. But this is actually the situation where strategic planning tells you now it's relatively cheap to invest. It's relatively cheap to hire very good people. Due to the fact that a lot of people are unemployed, they might try themselves in founding their own companies. They try alternatives for their working situations. So we get a turnaround at some point where the economy starts growing again. And then we get from the depression phase into the next phase, which again is the growth phase, or this new growth phase. And that's basically the idea how these key factors or key variables like wage, like interest rates, like labor or capital demand, investments, prices, develop in those 4 different phases. Well, that's actually pretty interesting, but this also necessitates us to know which phase we are actually in. That's easier said than done, because it's always pretty problematic to actually know, are we really in a recession phase? Are we still at the end of a boom phase? Are we in a recession or depression phase? And to alleviate this problem a little bit, we have so-called business cycle indicators. Indicators which tell us what is most likely for our current economic situation. We have in this context indicators which look back, indicators which look ahead, and something which reports more or less on the current situation. The ideal look ahead indicator is the so-called book to bill ratio. So how many orders do we have? That's also similarly working our inventory levels. If we have a push production, are we actually selling what we have? That's not so much a perfect look ahead because usually the inventory is already sold. The book to bill ratio really looks ahead. Inventory is in part, depending on your sales structure, it could be current situation, it could be look ahead. Then we have wage developments where we said that unemployment increases in recession depression phases. So this could also be an indicator which reports on the current situation. We have stock market developments. Similarly, I mentioned we will get into a bear market if we enter a recession phase. We can take a look in enterprise publications, in firm publications, and consider which announcements they make with regard to investments. Because if they plan investments, they will have a positive outlook on the economic development. So if we see a lot of announcements of larger investments, we can assume that we are somewhere in a growth phase. We certainly won't be in a recession phase. Then we have the Consumer Climate Index, which tells us a little bit about how consumers are consuming at the moment, which tells us also, due to the fact that we know that consumption, that demand changes over the different phases, what is the most likely phase regarding demand, overall demand, especially household demand. And the same thing which works for consumers works for companies as well. And that's where the last two actually go into. We have the doing business climate. That's more like the companies saying how they view the actual situation. Similarly, the buyer manager index works similarly to the consumer climate index, but not from a consumer perspective, but more from a company perspective. So this is just a short overview over possible business cycle indicators. Of course, there's way more, but this is just to give you a short, quick look that aside from the variables I mentioned in the 2 slides before, we have a lot of other indicators, some artificial, some normal like the stock market developments, we can use to get a good feeling what economic phase, what business cycle phase are we actually in, what developments are we facing in the near future. Well, this then concludes this session on the business cycles. So I say goodbye and see you next time.